Now, picture this. You're on your way to work and suddenly realize you forgot that lovely snack it took you a good 35 minutes to pack. You look around and you see a convenience store across the road. What do? You go to the store, pick up a couple of snacks, swipe your debit card, and boom, problem solved. That's what a checking account is for: quick access to your money when you need it. Tell me, do you already have a bank account, or perhaps you are trying to open one and all of a sudden all these questions start rushing through your mind? Does the bank have online banking? Do they have a mobile app? Where are the bank's branches? What are the minimum balance requirements? Can I use an ATM for free? What are the bank's fees? Do I even need both? Take a deep breath, lovely. You're in the right place. Today, I'll be breaking down everything, from how each account works to whether you should have both. Let's get straight into it. So, what is a checking account? A checking account is where your day to day money lives. When you get paid, it typically goes into your checking account, and that's where you'll pull from for things like rent, groceries, or even those late night snack runs. You know you do it, but anyways, one of the main advantages of a checking account is accessibility. When you open a checking account, you get a debit card, which means you can use your checking account for both in-store and online purchases. Plus, with checks, you can still write a physical payment if you need to. It's also really easy to transfer money between your checking account and other accounts, like your savings or investment accounts. Checking accounts are meant for transactions. Yep, that's what it is. You can deposit money, withdraw it, transfer it to someone else, or even pay your bills online. The idea is that the money you deposit into your checking account is used for regular, day-to-day needs. Your balance will fluctuate as you spend and deposit funds. And yes, checking accounts are actually designed to accommodate those fluctuations. However, with great access comes great responsibility. Checking accounts can come with some fees. Some of the most common ones include monthly maintenance fees. Some banks charge you just for keeping the account open. These fees can often be avoided if you meet certain requirements, like maintaining a minimum balance or setting up direct deposit. Overdraft fees. This one's a biggie. If you spend more money than you have in your account, the bank might approve the transaction anyway, but they'll charge you a hefty fee, sometimes upwards of $30 for every transaction that exceeds your balance. ATM fees. If you're not using your bank's ATM or an ATM in their network, you might get charged a fee, which could range from $2 to $5 for each transaction. But here's the thing: checking accounts aren't meant to be savings accounts. You don't earn interest on the balance in your checking account, at least not much, and that's because it's not meant for long-term growth. Checking accounts are ideal for spending, not for saving, and that's where your savings account comes in. If you're finding this helpful, please hit that like button so the algorithm can push this video to others looking to improve their finances. Thanks a lot, lovelies. Now, what is a savings account? Think of a savings account like a long-term hold for your money. It's a place to store money that you don't need right away, whether it's for emergencies, big future expenses, or just saving for a rainy day. Savings accounts are designed to make your money work for you, even if it's just a little. The key difference here is interest. Unlike checking accounts, which don't usually earn you any interest, savings accounts offer a way for your balance to grow over time, a bit slowly. In today's market, savings account interest rates are typically low, like really low. Think 0.01% to 0.1% annual percentage yield. But still, they're better than nothing. If you want a better interest rate, then you can also look into a high-yield savings account, which I highly recommend and talk about in one of my videos. Many banks offer high-yield savings accounts, but typically, they are more commonly found with online banks rather than traditional brick-and-mortar banks. Online banks can afford to offer higher interest rates because they have lower overhead costs. They don't need to maintain physical branches. But there's more to a savings account than just interest. The point is restraint. Savings accounts are meant to be a place where your money is less accessible, which helps discourage you from spending it all at once. Most banks limit how many transactions you can make per month. This is known as the Regulation D rule from the Federal Reserve. You can transfer money to and from your savings account, but the limits are designed to encourage you to leave the money alone and allow it to grow through interest. However, just like checking accounts, savings accounts can come with some fees. First is minimum balance fees. Some banks charge you a fee if your balance drops below a certain amount, and another fee is the excess withdrawal fees. If you go over the monthly transaction limit, you may face additional charges. Did you know that Canada Deposit Insurance Corporation, CDIC, protects eligible deposits of up to $100,000 per insured category? This deposit insurance protects your savings if your financial institution fails. It is free, and you don't even have to apply for it. It is automatic. How cool, right? So savings accounts are the way to go if you're building an emergency fund, saving for a major purchase, or working toward a long-term goal like a vacation, a car, or even a home. Do you need both? Which one is better? Honestly, neither. Each account has its purpose. Use your checking account for daily transactions. Your paycheck goes here, bills are paid here, and it's where your debit card or checkbook comes into play. Use your savings account for the money you don't need to touch right away, like emergency funds or savings for the future. While you technically could try to get by with just one, having both accounts gives you flexibility and discipline. The savings account encourages you to save, while the checking account keeps your day-to-day financial life simple. All right, now that you know the difference between checking and savings accounts, it's time to take a closer look at your personal finances. The video on your screen is a complete roadmap to help you get started. Click on it now. I dive deeper and answer many of the questions you might have. Drop your questions and comments below. I'd love to hear your thoughts. Catch you next time. Bye.